Hi, this is Andrew Faldy with SMBU, and this is going to be a very fast highlighted version of a recent presentation I did for the Options Tribe. So this is going to be the shortened preview version. If you would like to watch the hour-long version of this same information, you can go over to optionstribe.com and join there. So what I'm talking about here is filters and the benefit of using filters, and specifically in this presentation about using volatility-based sizing. So the purpose of that is to adapt to markets and market conditions objectively. So rather than using a fixed size of either share amounts or contract amounts in options or stock or futures, to actually use some variability and add some reason to your sizing that adapts to the market, and here's the key, objectively. Rather than just the amount of size that you prefer to take based on what you perceive to be the risk-reward. Without experience and without prior proof and evidence that you are capable of doing that, it may be better to pick something objective like volatility-based sizing. So your benefit is you have the ability to experience more consistency, and that increases when you smooth out the bumps in your equity curve that are largely avoidable with a simple filter. So what traders are looking for more often than anything else is consistency, and to increase consistency. And if there's a way to choose your sizing with a way that represents a more consistent amount of risk per trade and a more consistent amount of reward, then you're going to have fewer large dips in your equity curve and fewer periods of trading on tilt or taking too much risk, which throws out your ability to be consistent. So that consistent sizing is a great way to start to create consistency in your returns. And it doesn't mean always the same amount of size for every trade, but trying to take on a very similar amount of nominal sizing or very similar amount of volatility-based sizing is a great foundation to include. And then as you look at different setups, if your trades have different amounts of probability, whether it's an equity trade or an options trade, you have based on the trade itself and the setup itself, you may add some variability to that amount of risk. But knowing your baseline of the amount of risk that you should be taking is a benefit to your trading. So there are many types of filters, and the one I'm going to focus on here is the volatility sizing as number 2, but there are some other types of filters as well that can help in your trading. But always we want to keep things simple, but if it's too simple, that's not going to help us either. So it's a quote from Albert Einstein. So as an options example, something that would be too simple would be to always use $50,000 risk per butterfly. That consistent basic sizing may be too simple. Something that might be better would be a 3 ATR move in either direction should not exceed $10,000 drawdown. So that would be a way of saying ATR adapts to volatility, and your fixed amount would be your fixed risk of $10,000, but you have your variability based on the average true range. So ATRs adapt, and they adapt objectively, as we discussed earlier. A $50,000 butterfly could be risking a wide range of actual dollar amounts based on a 3 ATR move. I'll show that here in the next slide. So if this is a $50,000 simulated butterfly, at sometimes a 3 ATR move may represent only a $5,000 change in equity, or in other times in higher volatility markets, it's easier to achieve a 3 ATR move in a short period of time, which could double. And so all three of these, at $5,000, $10,000, and $16,000 equity changes, are all 3 ATRs, but in different market environments that have actually occurred over the last year and a half. So knowing what the current volatility and knowing what the current expectation of normal movement is in the market can help you change your sizing, either through hedging or reducing the size. Instead of a $50,000 position, you may have to take something smaller than that, so that a 3 ATR move, or what would be considered more normal for the current market conditions, still only represents the risk you're allowed to take. And that we were talking about 10,000 change. Sometimes that 3 ATR move might be only 5, and you can actually take more size than you would have been, and really maximize those great market conditions. Far dated contracts in lower volatility markets could increase your size, and near dated contracts. So even if you enter the same time for every trade, if you've waited and you're into that trade for a little while, 3 ATR move could start to create more volatility in your returns. Even though your delta may look similar, it may actually make a big impact on your equity change in your account on a 3 ATR move if you're near expiration. So that might mean you have to reduce your size closer to expiration if you're using a volatility-based size or volatility-based risk controls. So here's a list of filters. The ones on the left I feel are less effective, and the ones on the right are more effective. So I'm going to skip through this. You can hit pause if you would like to read through that. So I'm going to show you one quick example of a momentum-based strategy. This is not an option system. This is a trying to buy momentum strategy. And I'm going to show you how volatility-based sizing can improve the results of this. And this works across a very wide range of strategies, stocks, ETFs, futures, and other instruments. So this is just one quick example in one index, but really it can be, I could show you if I were to take more time and show you many different strategies at it, which I may do in the future if there's interest in this topic, volatility-based sizing. Just let me know. You can send me a direct tweet at Andrew Faldy and let me know if you like the concept and the topics of volatility-based sizing, and I'll try to show more information like that. So here is a chart. It's a simple momentum indicator where if momentum's rising you get long, and if momentum's falling you close the position. So I'm going to switch this off. So I'm going to turn off the volatility-based sizing. So what it's doing now is it's actually taking a consistent $100,000 position per signal. And so this strategy here, very simple momentum indicator, and this is not something I would recommend as a trading system because it's a little too simple and a little too volatile in the returns. You can see that when the market is not rising, it does okay, but when the market's full on in a bear market, the trades really can go against you pretty bad. So you can see here that there's this, it's generally a strategy that works. There's many trades. You got 140 trades that have a very similar pattern. Then the pattern breaks down violently, and then after that you have another, I'll even discount this as not too bad. It's just recovering from a very good period of time. So, and even just a whole another set of trades here, another 100 trades that work well. But this spike against you, this is what makes trading risky. Trading strategies that don't have a little bit of statistical validity to them, and making sure that you understand the risks of your trade. And namely, what I'm saying here is volatility-based sizing is a way to smooth out that risk. So let's see if we can do that. If all we're going to change in this, and here I have in the code that our position size, so we have two things, vol size on. If you don't know what this means, just ignore this part and I'll show you the equity curve afterwards. But if vol size is on, then what I'm doing is I'm actually adjusting my risk based on standard deviation amount. So whatever if the market moves one standard deviation for or against me, I want that to be no more than a $10,000 change. Otherwise, if vol is off, it's just a consistent amount of dollars in the trade. So what I'm going to do here is try to leave this on the screen as I make the change so you can see it happen. So what I'm going to do is I'm going to take that and I'm going to turn vol size on. So I'm going to be using a consistent amount of risk per standard deviation move in the market. So let's see what that changes. So you can see what happens is our consistency, the nature of the strategy, I make it a little bigger so it's kind of back that scale we had before. So the nature of the strategy is very similar. The trades are all very similar. That we're going to have the same statistics behind the trade. But what happens is that large spike down in the market, where that huge change in our slope. So we have the slope that moves upward at this speed, and then it moves down at a very similar speed, and then it moves up at a very similar speed. We're adding some level of consistency to this overly simplistic strategy, but what I'm showing is just the benefit of adding volatility-based sizing alone is helping to reduce the variability of returns, helping to reduce the erratic nature of returns that can happen if you don't use a little bit of sophistication in your position sizing. So overly simplistic strategy to drive home the point of one thing, and that is volatility-based sizing, or changing the size of your positions based on the expected day-to-day movement or periodic movement of whatever you're trading, can add some value in the sense of reducing total risk when things become more volatile. So just kind of a fast way of getting through this same information that recently was presented on the Options Tribe. And like I said, if you want to watch the full-length version of this and a couple hundred other options trading related videos, you can go to optionstribe.com and join. Otherwise, head on over to smbtraining.com and make sure you are opted in for the free daily video, or you can go to smbu.com. is a little shorter way to get to that. So smbu.com, navigate to the free daily video and get more videos on trading topics that will hopefully help improve your trading. Thanks a lot.